Today, folks, there's no doubt about it. The Canadian stock market is in absolute freefall mode. It is crashing, and we're going to break down what has kind of led up to this current market environment, when the likely turnaround story is going to be as we analyze some super high yielding dividend stocks, the banks, the telecom sector. We're going to roll back, talk about the immigration side, the interest rate side, how that's affecting the housing market, and so much more data in between. As there seems to be a microscope on Canada right now from housing and the political crapshoot that's been going on. And if that is a conversation you'd appreciate, as always, hit that like button, because first and foremost here, it only took 2 weeks for the Toronto Stock Exchange to collapse to a year-to-date low, dropping 7%. From a heat map standpoint, oil, energy, that supported it and propped up the whole market up till this week. I mean, we saw C&Q, Enbridge drop 3% alone today. The banks are dropping in double-digit rates. Like, this is something astounding here, but is it sustainable, or is it setting up to be a huge buying opportunity? Well, this story has to roll back to where it starts, and that all comes down to immigration. Canada recently hit 40 million people, and it isn't from the birth rate, people. It is from immigration, where we're getting one new person every 1 minute and 5 seconds, and from a non-permanent residence, we're getting one every 53 seconds. The immigration is just absolutely mind-boggling, and you can see where these immigrants go. That's the crazy thing, that Stats Canada shares this data with you. For instance, most Asians want to live in Ontario, specifically Toronto or the surrounding GTA area. I mean, you look at Americans, they really want to go to Quebec. Africans want to be in Alberta, and Vancouver is mostly Europeans these days from the immigration standpoint. I don't know if this is accurate, but this data is really odd that I can just pull this up from Stats Canada. But taking a look, you're going to see headlines like over 1 in 5 new Canadians are considering leaving because of the cost of living is a major factor. Canada's recent immigrants are unhappy with housing after real estate prices soar, and these articles are just clickbait titles. I don't think they really represent how astounding Canada's growth really is right now, because it was a bit of a slow period coming into spring, but basically you're going to see headlines like monthly rates of immigration to Canada slowed for the second consecutive month. But nonetheless, in the first 3 months of this year, Canada welcomed 145,000 new permanent residents, putting the country on track to set a new record of 581,000 immigrants this year. I mean, it's astounding, right? Because if you take a look, Canada has 424 housing units per 1,000 residents, and that number is dwindling like you wouldn't believe, which basically puts them well below the G7 of 471. And to make good on the shortfall and catch up with the G7 average, which means they'd have to build a massive 1.8 million new homes, which God knows that's never going to happen, right? But just take a look at this, because basically the average asking rent in Canada increased 1.8% on a monthly and 9.6% on the annually. And you can just take a look at how insane it is now. To get a 2-bedroom in Vancouver is going to cost you about $3,800 a month. In Toronto, about $3,400. Now, if you turn on any media, you're going to hear that we are at the breaking point. The entire housing is going to collapse. The bubble has finally come to its deflationary period. But the fact is, the data is not really supporting that. For example, if we take a look at the delinquency rating off CIBC's last earnings, which has some of the largest exposure to Canadian mortgages, we can see the Canadian residential mortgages from a delinquency standpoint. This is 90 days delinquency. We're seeing that they had a 0.3% during Q1 of 2020. That was right going into the pandemic. Yet now in Q3 of 2023, it's actually almost half as much as it was during that time period. Now, this could change. Maybe I'm not seeing something. Maybe the economy is going to snap and housing is going to collapse. The real question too is, if somebody can't afford their mortgage and they have to put it up for sale, just because they can't afford the mortgage doesn't mean the housing is going to collapse. So long as there's somebody there to buy that home from them and take over that mortgage at a reasonable value, they can get bought out of it, right? So that is the real defining question here, but none of the data says right now things are collapsing. So people need to take a breath here, but what is collapsing are these stocks. I mean, you take a look at Canadian Imperial Bank right now, it's yielding 6.84%. It's hit its year-to-date low. It's sitting at basically a 52-week low and has knocked out damn near 5-10 years of its market value, which is just absolutely jaw-droppingly staggering. But let's talk about the telecom giants. Let's talk about the turnaround. How far can these things go before we start seeing a lift back off to some normalcy here? Now, I think this is getting a bit overextended from the sell-off point, but that's because people are trying to predict on when interest rates are going to have a full-blown impact on these stocks, because for as long as we expect interest rates to go higher and stay higher for longer, it's going to continue to bake into the earnings of these companies. And TELUS is a great example. It's one of my favorite examples of the double-edged sword we're living between record immigration, building up crazy client lists for these companies, but also getting hindered by the insane interest expense. So TELUS right now is yielding 6.78%. It is now down a whopping 37%, returning to its pandemic lows, wiping out 5 years of gains in capital value from this company. But when we take a look from an operation standpoint, their mobile phone net additions of 110,000, which was their best second quarter since 2010. Crazy that is. Thanks to record immigration, right? But then again, you go back into the interest expense, they paid $316 million for the last quarter. Over last year, that's up 64.6%. So these companies are struggling to try and make up that lost hundreds of millions of dollars by laying employees off, cutting costs, trying to expand margins a bit. But the fact of the matter is there'll be an inevitable inflection point. What's going to happen is after a couple quarters, once interest rates have reached their peak, it'll bake into some of these corporate earnings. And then comes the next cycle of the market when they start cutting interest rates. And because they've laid off employees, they've refined the business. As soon as they start cutting rates, you'll immediately start seeing the impact on some of this corporate debt, especially if it's a revolving credit and they're not locked in rates. All of a sudden, they can start adding that back to the bottom line, and that's when the market will turn around. I don't know when the bottom is going to hit, but we're kind of stuck in the midst of this hurricane as it stands, the eye of the storm, so they say. But take a look at some of the banks, like Bank of Montreal right now hit a 52, or Bank of Nova Scotia, sorry, hit a 52-week low at 7.11% on the dividend currently. Enbridge here, my God, these infrastructure plays that are heavily debted. I mean, this company just did a huge acquisition. It's the largest natural gas power player right now in North America and the largest pipeline company globally with an 8% dividend yield as it stands today. Take a look at the biggest companies in Canada. Royal Bank, another year-to-date low with a 4.6% dividend. Even the oil market's the only thing keeping propped up the Toronto Stock Exchange. But if this starts to turn around and oil starts to come back down a bit, I mean, we're going to see a lot of continued pain across the broader Canadian economy. I mean, Suncor, Canadian Natural Resources, companies have performed greatly coming out of the summer, right? I mean, from the bottom there, I mean, Suncor was up, 17, 20% at the peaks. So very astounding stuff. Now, look, I think what we're seeing here is a combination of a political microscope on a global scale of people looking at Trudeau, what was going on in the House of Commons with the Nazi stuff. You're taking a look on a provincial level with like Ford here, not being allowed to open the Greenbelt, and a lot of, maniacally, insider stuff going on, or so people speculate. And then you take into consideration interest rates, and if the entire housing economy is going to collapse with immigration, how is that going to get impacted? What does this mean for corporate earnings moving forward? And all of this just bakes into an utter amount of fear, and people saying, forget this, I'm going to be fearful instead of greedy when the market is tanking, and they're going to put their money onto the side, put it in a money market fund or a high interest savings account. But I'm here to tell you that if you're not looking for opportunity, you're never going to see it, and you're never going to make real money in a macro environment like this. Now, I think we're going to see continued pain likely for maybe the next 6 months, but this is the best place to take advantage. I don't know if you should cost average into broader index funds or if you should be buying some of these individual dips. That's for you to decide. But I do want to tell you, I heard a great saying that if I asked you how many red cars did you see on the way to work, you might say, I don't know, maybe 1, 2, I'm guessing, right? But what if I told you I'd pay $100 for every red car you saw on the way to work? Oh, all of a sudden those numbers are going to expand dramatically because you're looking for red cars. Opportunity operates the exact same way in the stock market. If you believe the glass is half full, if you believe there is opportunity, you will find it, and you will hopefully take advantage of it when the market gives you these lifetime, decade opportunities for higher yields and potential future growth rates when they cut interest rates. I'm telling you, this is the opportunity. I'm just stating it, but I'll pass the question off to you. I'd love to know what you think about this conversation in that comment section below.